Okay, good evening, everybody. Right. Thank you for joining us this evening. Right. Just give us a few minutes for other people to join in. All right. Cool. How's everybody doing? Okay. All right, guys. If you have any questions, please put it in the Q&A. All right. Okay. All right. We're gonna start in the next 2 minutes. Yep. So just a little bit of introduction. I'm Ethan from Investing Note, right? So today we have two special guests. Of course, Adrian to my right or left on the screen, right? So Adrian Chu is from CSOP Asset Management, right? And next we also have Benjamin Chan, who is from CGS-CIMB, and he's a research analyst there, right? So, before we start, give them your full attention. All right. This webinar is going to be very interesting. Okay. All right. So let me power up the slides. Cool. And okay, so this is how it will the webinar will go. So it's interactive. So for us, for the audience, please put in your questions inside the Q&A, right? And not the chat function. Okay, I just saw a lady called Ivy actually asking whether this webinar is recorded. Yes, this webinar is recorded, right? You'll be on our YouTube live. Cool. All right. Okay. Benjamin, are you there? Okay, just give us a few minutes, guys. All right. Okay. So it's 8:03. Let's start. Can you guys see my screen? Is it full screen now? All right. Okay. Ethan here from Investing Note. Welcome everybody to today's webinar. Topic, of course, investment opportunities in China's tech sector, right? So, this webinar is super well received. We have a lot of people coming in right now. And without further ado, let's start. Okay, just to introduce our speakers, right? First of all, we have Mr. Adrian Chu, who is actually a vice president at CSOP Asset Management, right? Adrian, you can say hi. Oh, he's on mute. Wait, just give me a minute. Yeah. Yep. Adrian, you're okay.
Hi. Yes. Thank you. Thank you for unmuting me. Thanks. Thank you
No
for
worries.
the opportunity for tonight. Yes. I think it's exciting time right now. Right now there's a lot of activity going on in the tech market. So I think this is a good time to organize such a webinar to tell the investors what's going on, to share our views from CSOP. Yeah.
Great. So next, of course, we have Mr. Benjamin Chan, who is a technical and quantitative analyst from CGS-CIMB Research. Hi, Benjamin. How are you doing today? Oh, he's on mute as well. Yeah.
Good evening, everyone. Thanks for having me.
Yeah, cool. So, throughout this webinar, if you have any questions pertaining to the webinar, to the topic that we are covering today, please put it in the Q&A section, okay? All right, so without further ado, let's start. Okay, a couple of disclaimers first. This is the standard protocol, okay? Take some time to read it. Let's move on. Okay, so the last couple of weeks or even months, right, we've seen, you know, a lot of stocks being sold down, of course. So, you know, a lot of the focus was actually on, you know, the treasury yields, right? And, you know, this kind of fears of inflation is actually, you know, boggled minds of investor. So, you know, of course, that is part of, you know, the global macro scene, right? So, how actually would interest rates, you know, affect the other side of the world, the East, which is China, right? So, you know, I would like to ask Benjamin, right? So, could you give us an overview of, you know, what's this global macro scene right now with, you know, inflation, you know, rising bond yields, right? Could you give us, you know, that insight?
Yes. Thanks for setting the scene, Ethan. You know, the US 10-year Treasury yields have been on a long-term decline. You know, since the highs back in 15.82% back in 1981, we've actually, as you can see here, it's been on a long-term decline, making a series of lower highs and lower lows. And it often means that it mean reverts back to this red dashed line that you can see over here. Obviously this is quite correlated with the consumer price index year on year, and we actually hit a record low of 0.31% in March of 2020 last year, forming yet another lower low. And as of today, we are at 1.63%, and mean reverting back to this red dash line here. So, I mean, looking at a global long-term perspective, it's actually there's nothing to be alarmed for this bigger picture. If I narrow down to a 10-year time frame, this is the 10-year Treasury yield against the major indices. I talked about the mean reversion early on, but as you can see here, the Nasdaq and the Hang Seng Tech indices have outperformed at 490% and 182% respectively. So more often, whenever the US Treasury yield mean reverts and where the red arrows are, the major indices have a retracement. And this often happens during the second half of the mean reversion. So as you can see, the percentages the drops often correlate to this mean reversion where I've indicated with the red arrows. Now let's zoom in even more to a 6 months time frame. So recently, we have seen this US 10-year Treasury yield increasing in a strong manner. Over the last 6 months, we've increased by over 110%. After spending the last whole of 2020 below the official inflation rate, which is historically a typical, mainly due to a Fed intervention as the biggest buyer, last year, the US 10-year Treasury yield continued to push higher and higher. From August 2020 at a low of 0.50%, there has been a steady upward move in this 10-year Treasury yields. However, since the start of this year, we have seen a negative correlation between the 10-year Treasury yields and the major indices, and we saw a major retracement in these indices, with the technology sector the hardest hit. With that, I'll pass on to Adrian to kind of enlighten us about this negative correlation between our major indices over the past couple of months, and the US 10-year Treasury yield.
Thank you, Benjamin. Thank you, Ethan, for that. So, from CSOP point of view is that, we, ever since, the February high, the high in February, and then we saw like, a retracement from the high, a retracement of 26% down, since after the Chinese New Year, and that got me, and the company to start a journey in terms of researching, what's happening, and we went out to do a bit of research, and this is what we come out with. We found a clue. We came out with this Wall Street Journal, and they came out article saying that Japanese investors are actually selling off the US Treasuries. If you sell off the Treasuries, the price goes down, and that's what push the Treasury yields a bit higher. And through the article, we found out that fundamentally there is no change in terms of the macro outlook. Fundamentally, the Japanese just wants to book their profits, and there is nothing change within the being on the macro outlook. So what the article says is that Japanese are selling US Treasuries, then cause the yield to goes up for the last in February and March, cause the yield to go up. And having said that, fundamentally nothing has changed, and if the yield is actually very high, after the new fiscal year starts for the Japanese banks and insurance companies, they will actually come back to buy the US Treasuries again. So this is one of the reasons why there is actually not much of a concern for inflation, but actually there's certain external forces such as Japanese investors are selling off US Treasury, causing the yield to go up a little bit. Most of the selling for US Treasuries happened during, according to this article, happened during the Japanese trading hours. So fundamentally, it's not the rapid increase in terms of yield for the 10-year Treasury, for US Treasury. It's not regarding of inflation. Inflation risks remain pretty low in that sense. And having said that, we also did a bit of research. Is that what's the relationship between the 10-year Chinese government bonds? At what yield would the Chinese government bonds cause the CSI or the equity China equity markets to go inversely correlated to it? And we found that the yield is actually at 3.5. So if the China government bond, which I believe all investors should look at, is the 10-year CGB yield. So at 3.5 yield percent, that's where the CSI 300 will be inversely correlated. So right now, we still see a bit of correlation, but investors who are investing into China market should actually take a look at the Chinese government bond 10-year yield. So if anything, if the yield goes up to 3.5%, that's where we should be concerned, where equity markets will go inverse for Chinese market. And let me say that. Can I go to the next slide, please? And so I think Benjamin did set a good stage for me in a sense. We look at the history of interest rate for US. The term QE started in 2007-08. That's where the global financial crisis, and that's where the Fed started a QE activity. So what happened is in year 2010 and 11, that's where we've experienced the first QE tapering tantrums. Right, you see that the green line will be the spread between the 2-year and 10-year Treasury yield, the term spread, and that's where the spread narrows down, and that's where Fed was actually inexperienced in how to withdraw that QE from the market, and that's where the market fell. And then in the next event of QE tapering tantrum happened was in 13, when Bernanke says that they want to raise interest rates and things like that. Again, there was a tantrum going on through the markets as well. And then that also happened in 2016 and 17. So these are some of the 3 examples of some of the QE tantrums. What we think is actually the situation right now for us, we are more similar. We are in a similar position for the second arrow, which is actually 2013. Next slide, please. So in 2013, there was indeed if you look at the down arrow, right, there was actually a sell-off in the equity markets. It called a QE tantrums, right? And that's where Bernanke said that I want to raise interest rates high. And sure enough, there was actually a small dip in the market when the Fed said, I want to raise interest rate. There was a small dip, but with so much liquidity in the market at the moment, right? You could see that, for be it Dow Jones, S&P 500, and NASDAQ, the market just, continue to, record fresh highs. And with so much liquidity on the side, they will come in and they will actually buy into the dips. So it seems like this is the trend. There's so much, QE money on the sides. Whenever there's a dip, there is actually a buying opportunity that investors will just come in to absorb the dips and look for bargains in terms of the stock market. So this is what is happening for us right now.
Right. Thank you, Adrian and Ben, for the insight. So I think they actually set the tone and the global macro outlook that a lot of retail investors like you and me are actually pondering about. So I think for the purpose of this webinar, right, let's put our focus on China. The key question is, where are we heading?
Yep.
Hi Ben, are you there?
You got to unmute him. Yes.
Cool.
Yes, that's actually a good point to start with. We'll start with the Hang Seng Composite Index, which is a good representation of the Hong Kong market itself. Over here, this is a 2-year daily chart of the HSCI, during which the market has yielded at 12.29%, and over the past 1 year, the HSCI yielded a total of 34.43%. As you can see, we are currently the HSCI has been trading within this trend channel here, and as of early November of last year, we broke out of this 2-year resistance level at 39,550 with the first purple line, and it's continued trading higher. It briefly broke above this intermediate trend channel at the top in February, rallying to an all-time high of 5,058.89 before retracing back into this trend channel. And obviously, when all the indices had a retracement, so did the Hang Seng Composite Index. Moving on to the technical indicators, I have over here the RSI, which is a momentum indicator, has been bouncing off this oversold region, indicating the weak market. I'm sorry, indicating a strong momentum, and the modified MACD, which is our trend indicator, has been trending positively above the zero line since July of last year, and has been the longest period it has been in a positive for the past 2 years, indicating a healthy and sustainable trend. Now, back in December of last year, we actually had a webinar, a similar webinar like this, and I spoke about this HSCI being in the lower half of this segment of this trend channel, which meant the risk was much lesser to open fresh positions. Indeed, it rallied higher, as I said, to all-time highs out of this trend channel, and also been well supported by the 20-day EMA. So, which is this white line in between the trend channel. We are currently in a similar situation as we were back in 2020, where the HSCI is actually in the lowest half segment of this trend channel. Now, where to next? Given the current momentum, we expect both the HSI, the Hang Seng Index, as well as Hang Seng Composite Index to continue moving higher. And over the intermediate term, we anticipate the HSCI and the HSI to climb higher within this intermediate trend channel, and likely to test the all-time highs of 5,000 in the near term.
All right, thank you, Benjamin. Yes, so I thank you for that. I mean the TAs of like HSCI and stuff like that. But I would like to chip in a sense of the more of the fundamental, the macro indicators going on right now. So China, it's actually a story of recovery for 2020 and 2021. We believe that it's actually a year of growth for China. Now they have a very strong first quarter for 2021. And why do we say that? Because we look at two bellwether indicators, which is the manufacturing PMI and the non-manufacturing PMI. And if the PMI comes in above 50, they are going through an expansionary phase. That means the sector is actually going through a phase of growth. If the indicator will come in below 50, which means that the sector is actually going through a contraction. So manufacturing PMI after the Chinese New Year came in at 51.9, and that's actually a huge increase from February of 50.6. Now, as we know, in just before Chinese New Year, there was a minor mini outbreak in China in terms of the COVID-19. So, Chinese government was very quick to clamp down, to test everybody, and then to impose a necessary lockdown if need to make sure that the outbreak doesn't go out of control. So they are willing to, they have actually room or space. I mean, there's a lot of room and space for them to actually do this kind of clamp down because they are still having healthy expansionary kind of growth. And recovery and growth is actually uneven. For example, the non-manufacturing PMI came in at 56.3 versus February 51.4. So again, due to the COVID, they went locked down, but after that, it managed to control. And then in March, the service sector came in at 56.3, which is actually a very good number. These are actually very, very healthy numbers. One thing to take note actually the unemployment. During the peak of the COVID-19 last year in February, the unemployment was actually 6.2. A year later, it actually brought it down to 5.5, just a bit higher from January. It's because of the COVID-19. There was actually some form of layoff, but I think there's still a very healthy situation within China. I think they are in the continued growth, a very strong Q1 for 2021. Then we look at import export as well, right? So just yesterday, the March export came in at 30.3%, and the import came in at 38.1. So these are actually very resilient numbers coming in for both import and export as well. The trend that we observe is that there was one month export would be higher than import, and this month import would be higher than export. So this is the reason because China has to import raw material to create the end product to be export out. So we could see actually a fluctuation of higher import, lower export, and higher export and lower import the next month. So right now, looking at year-to-year growth, they are doing very well as well. Now, one thing stand out is with China is actually the export, right? In terms of global market share, China actually gained 2% last year. Due to the swift lockdown, they were able to get their workforce back into the factories and working and manufacturing faster than the rest of the competitors in foreign countries, which is only experiencing a recovery right now, right? So they managed to gain 2% in terms of market share. So this is actually a very good example how they turn a crisis into opportunity. And I think actually, that their trading surplus is actually very healthy. Last year, they have actually $535 billion in terms of trade surplus. So it's actually very healthy numbers. So most of the countries, they're actually, what surprises is actually most of the export to developed market rather than in emerging market. This is actually possible that, vaccination is actually ongoing much faster in developed markets. So I think this is actually some of the very healthy numbers going forward. Next slide, please. And then looking through, what we think is that 2020-2021 is actually, turning the vaccine hope into reality. We believe the GDP growth for China will be at 7.9, even though they just announced that they were looking at 6% this year. UBS came in and put a bold forecast that China will actually come in at 9% GDP growth this year. Now we believe that this is actually able to be achieved based on three reasons. One is actually COVID-19 globally, and within China is actually very well controlled. The US and China trade tension probably would actually reduce in the coming months, we hope. And, these are some of the reasons going forward. Now, the key reason is actually we also believe that we can hit 9% or 7.9% is actually the retail sales, which is actually about 40% of the GDP. And we believe that retail sales will be leading the GDP in a sense because of lack of international travel. They're all cooped up in China. And and pent up savings that I think they will actually boost their retail sales domestically, and that would also improve their import as well. So what happened was that actually what we saw is that over the past year to date, right, China showing signs of recovery and growth. domestic consumption is actually very good. Investors are using, I mean, the Chinese population are using technology more. There's a more acceptance in terms of technology. So if you compare, Chinese New Year to Chinese New Year in 2019 and 2020, there was an increased adoption in terms of using mobile apps for remote work already. So you could see there's a trend that has been kickstart. Next slide, please. And when they say it takes 66 days for someone to create a new habit, and what's the impact of the COVID-19 is that we could see that the e-commerce for Chinese e-commerce will continue to grow 13% per annum on the average, reaching $158 billion by 2024. So the e-commerce market is going to continue to grow at an average of 13% per annum. The number of users using e-commerce will continue to grow by 25% by 2024, reaching a 1,158 million users in 2028. Next slide, please. And most of these, this COVID-19 actually create a large pool of online shoppers, and 36% of the online shoppers are actually from the high income. So this is actually the wealthy, not only the middle class, but the wealthy are also using to shop online as well. 68% of the population in China shop online. And having said that, of these 68%, a very young there's a very young pool of Chinese citizens are actually investing. I'm sorry, they are using to shop online, and the average age of online shoppers are actually 24 years old and below. So this is actually this is going to continue to have a very long and strong long-term trend in terms of the tech sector going forward.
Okay, Adrian, thank you for sharing.
Yes.
If we were to give a report card to China as a person, right? This is like stellar growth that we are seeing, right? We're expecting at least, right? Yep. So let's move on to actually talk about the Hang Seng Tech Index, right?
Sure. So I mean, this is the Hang Seng Index provider. Monitor the situation between China and US, right? It seems like right now there's a possibility of the digital iron curtain falling on the China ADR listed on the US exchange, right? So Hang Seng Index provider thought like, hey, why don't I launch a third flagship index, which is the Hang Seng Tech Index? And what it does is actually this Hang Seng Tech Index is actually it has to be of Greater China company, focusing on sectors such as IT, consumer discretionary, industrials, financial, and healthcare. Now, the most important you have to go through the team is actually cloud, digital, e-commerce, and fintech and Internet of all things. So this is to ensure that the company within this Hang Seng Tech Index represent the current technology sectors within the China market, right? Then to ensure that these companies within the index continue to grow and do not be obsolete, do not be resting on their laurels and let the market eat them up and be obsolete, they need these companies within the index, right, to be investing 5% or more of their revenue into research and development. They want investment into new products. Or revenue growth year on year is 10%. That means the existing product is actually what is what's the population wants, disrupting their life. So they want these two criteria. Next, actually they cap each single stock at 8%. So this is actually maintain that the index is actually providing some form of diversification in terms of the companies. It doesn't be skewed towards the top, the top tech companies within Hong Kong, within the Greater China, right? So they want a more diversified kind of exposure. Now, the IPO fast entry rule, that's something that provides a quick reaction to investors. But having said that, it's because technology is always constantly revamping themselves, refreshing themselves very fast. So they want to have this fast entry IPO fast entry rule, so that the new companies going in are actually very so up to date, right? And so I've highlighted our top 10 constituents as of yesterday's. So Kuaishou and JDF benefited from this IPO fast entry rule. Baidu, Baidu was also added into last Friday into the Hang Seng Tech Index as well, but unfortunately it's actually not within the top 10. It's fallen off due to the price fall. But Baidu was actually one of the examples also benefited from this IPO fast entry rule as well. And I think this is actually the most important chart of tonight, right? So what we observe, whenever there is actually a event in the market, right? So for example, last year, November, Ant Group IPO was suspended. China coined a possibility of like doing their new anti-monopoly policies, right? The market tanked 10%, right? And we observed there was actually new inflows of funds into the sector. Then next was actually near in December when NYSE threatened to delete sanction Chinese companies due to the executive order by Donald Trump. We also observed there was fund inflows coming into the technology sector as well. Beginning of year, Tencent was actually being fined and was actually under scrutiny. When you drop Tencent, we also see a huge inflows buying into the dip as well. Now, the biggest fall was actually, like you mentioned, the purpose of this webinar is actually there was a huge interest, huge rapid interest of increase in terms of US Treasury yield, possibility of inflation, and then possibility of like interest rate hike, where it's going to be more difficult for technology company to borrow money for their research and development. That's why you saw the Hang Seng Tech fall about 60% from the 26% from the high. The harder the fall, we see more and more inflows into the technology sector. I think that's actually why. The next slide will tell you why, the reason why there's actually a huge inflow. Yes. So we saw the valuation chart, right? The best we can do look into the future is actually look at the best estimate of the PE ratio going forward. Now, if you look at Baba, which is Alibaba listed as an ADR in Nasdaq, right? So we know that they just recently got fined and it's about 10% of last year's revenue and everything. Right now, in terms of price to cash flow and price to PE, which is actually the brown line, right? It's actually come off from the high. I think we believe right now the valuation here right now is actually very fair. We believe that Baba is done and dusted. They have actually gone past the worst. And looking at the valuation right now, that was actually the reason why we saw a huge inflow, because after all this news and everything, the valuation actually come off. It's actually psychologically investors are more willing to invest into Alibaba, right? So we see Baidu the same thing as well, came off the high. We saw Tencent also came off the high. That's the reason. I think that's one of the, besides the trend, the macro picture, but I think we believe fundamentally we saw a huge inflow was because the valuation actually came down. It's much fairer, even though there's actually more fines touch wood going forward. The valuation is actually factoring all this price, all this noise events into their prices already. Yep. So back to you, Ben.
Yes. So talking on the tech sector itself, of course, CSOP has an ETF that tracks this index itself, and it's actually 3033. The ticker code is 3033HK. It is actually the first ETF to track this index. It is physically replicated, and it comes with a management fee of 0.99% and with ongoing charges. It has the largest AUM at 8.2 billion Hong Kong dollars. And looking through the shareholders, they actually have a more diversified clientele spread out, which is less concentrated. Furthermore, it is actually it has the largest market cap at 8.26 billion Hong Kong dollars. 3033, the CSOP 3033 has actually 12 market makers, and based on my observations, they have tighter bid and ask spreads. In Hong Kong itself, there is an exchange waiver fee for ETFs, And most importantly, I think in terms of the trading hours, it trades in the relevant trading hours in Hong Kong, which reduces the trade tracking difference.
Right.
Yes. So now what does the Hang Seng Tech Index look like? The Tech Index has been since inception in July of last year, has been trading within this intermediate trend channel. And it rallied to a high of 11,001.78 in February. And along with the major indices, it has retraced over 30% to the middle of March last month, and we can have actually on a technical basis we have a nice support at 7,880, and we are likely to see and anticipate this index to trend up higher going forward. Now, so if you wonder what are the, I guess, best performing and laggards since inception of this index, Kuaishou is remarkable over the 6-month period, followed by Lenovo at 88%, and next would be Hua Hong Semiconductor. The 6-month return for this Hang Seng Tech Index is 5.19%. However, amongst some of these names over the past 1 year, consistent outperformers have been Hua Hong Semiconductor at plus a positive 230%, followed by Weimob at a positive 224%. The other notable names in what you can see is Lenovo at 144%, semiconductor manufacturing at 85%, and Sunny Optical, just go back one slide, and Sunny Optical at 61.33% over the past 1 year. So you can see that similar names over the past 1 year have been consistently in the best performing over the past 6 months. Now, if we zoom into just this year itself, okay, you can see as well. I think you can see similar names mentioned in the previous slide. Year to date, though, the Hang Seng Tech Index is at minus 2.38%, and obviously since this retracement for the tech sector, it has had a negative return year to date. However, some of the household names like Weimob, Hua Hong Semiconductor, and Lenovo have been strongly performing, and you see the similar names happening. So I think those are names that are quite. Those, I can say, those are household names, and these are also names that are actually in this 3033 CSOP ETF. On the worst performing, so some names that aren't too good. Notable names would be Baidu, as we mentioned earlier, at minus 15%, Xiaomi at minus 23%, and JD Health at minus 26%. These are some of the laggards, but I do see the worst is more or less over, and we should expect or could anticipate further upside from here on.
All right, thank you, Ben, for sharing. So, Kuaishou, just recently IPO'd. So, like what Adrian said earlier, they had the fast track thing into the Hang Seng Tech Index, right? So it's pretty interesting.
Yes.
All right, so let's move on, right? So before Donald Trump actually changed hands to Joe Biden to become the president, he actually had this holding foreign companies accountable act. I think pretty much all the audiences here know what it is. So we actually thought that with Donald Trump being out of the picture, and this is not going to be so enforced, but right now it's becoming more of a law, right? So Adrian and Benjamin, correct me if I'm wrong. So this actually sparked off a sharp sell-off in those US listed ADRs such as JD, NetEase, and Alibaba, and it probably caused companies like Baidu to do a dual listing in Hong Kong as well, right? Recently, right? So also the last few weeks we heard that hedge funds like Archegos Capital had massive margin calls and sell off, right? So for with all this things happening right now, can you guys share about what's gonna happen, or at least some insight on what the future of Chinese tech sector is? I think our audiences are actually boggling their minds as well.
But I think that's a very good question right now. So let's take one step back and look at what's the motivating factors right now that why Hang Seng Tech is actually being born and created, right? It's because of the China US tension right now, and with this act going forward, you could see that there are many unicorns within China, and with that, what's happening with the act, with the sanction list going forward, these unicorns will naturally just want to raise monies and within the Hong Kong exchange or the China exchange, right? So we have TT, we have ByteDance, all these are some of the unicorns that actually have not listed in any exchanges worldwide. So most probably, if this were the rule for listing, these unicorns would have definitely choose Hong Kong or China market going forward, right? And so some of the ADRs names were like Baidu, right? The star there has actually benefited and actually added into the Hang Seng Tech itself. Trip.com is actually in the process of got approval, and we believe that Trip.com will be eligible to be added into the Hang Seng Tech if on the first trading day the market cap is closed within the top 10. Yes. Next slide, please. So we also know that like NIO and XPeng, some of the EV cars also starting to put up the dual listing process with the Hong Kong Stock Exchange. So I believe this is the future of the Hang Seng Tech going forward. Those ADRs are looking to do a dual listing in case what happens after 3 years, the holding accountable act happens onto them, they are forced to delist. They already have a safeguard, a safety net on the Hong Kong Stock Exchange, closer to the clientele they are using their products already going forward.
Wow,
Next
that's
slide.
cool.
Yes.
Right. Thank you for sharing. Essentially, I think for in the case of NIO and Xiaopeng, they are definitely listed in US, but of course they are China companies, right?
Yes.
So let's move on, right? So also, China recently ended this National People's Congress where they had like a whole day thingy where they make plans and all that kind of meetings, right? So what are the insights and updates on this China's 14th five-year plan and its growth potential? I think Adrian, in our last webinar, I think somewhere last year, is there any changes that you can share with us?
Yes, sure. I think back then they were just only like very major themes going forward, but with the National People Congress and the 14 five-year plans, they are actually putting out roadmaps already. They're putting out numbers to their teams going forward. So one is actually 6% GDP growth target. That's the big macro picture. They do not want to change GDP. They want to put 6% GDP growth due to the uncertainties macroly with the pandemic going on right now. My apologies, there's a bit of okay. And then they want to do more investments into transportations. They want to do IT infrastructure. They want to build 5G, AI, data centers going forward. They also want to achieve carbon neutrality by 2060, right? So they're talking about renewable energy, hydropower, EVs, cars, and everything like that. They also, within the financial system, they want to open up domestic market. They want to internationalize renminbi. So this is actually for the financial sector. Now, one is actually that's actually being talked about most frequently is actually the dual circulation. It's a new and dominating theme right now. They want to use technology going forward. So right now, innovation into technology is actually lacking in China. With the cheap, bans exports from US, right? They want to boost to being self-reliance. And having said that, right now, infrastructurally, the lack of government sponsorship and support in terms of R&D. So it's believed that within this 14 5-year plan, they say that the Chinese government will spend more than 7% annually into R&D for innovation, tech innovation. And with that, they want to increase reliance not from the external consumption, but want to build it with it internally. So this is some of the lampposts, some of the key goals that they have for China as well. So all this actually will be very will be a supporting factor for the Chinese technology sector going forward. So having said that, they also have like healthcare, right? So healthcare will continue to grow with the pandemic going on, right? So they realize that they can actually spend more money onto most of their GDP on healthcare. So right now they only spend about 5% of the GDP onto healthcare. So there's actually more room for them to boost up their infrastructure in terms of healthcare and biotech and everything. So they're going to increase about renminbi $600 billion annually to help to boost up the infrastructure for healthcare. And the reason they have to do so because population within China of age 55 and above is going to increase from 24% to 33% for the next 10 years. So they have to spend this money as well. So this is one of the key reasons that they have to spend on healthcare, on biotech. The next slide, please. And then on one team is actually on achieving carbon neutrality by 2060. EVs right now are a very popular team. And we could see that there is a sector within China that's actually some of the companies are actually managing or are related to EVs cars going forward. So we do have, for example, Chinex, right? Chinex, they have industries that are actually very relatable to EV cars, right? And Chinex within the constituents, Chinex, right, which we call it the China Nasdaq, has about 22% into EV cars related sectors. And out of these 10, 3 of them actually holds about a good 15% weightage of the index as well. So I deviate from the Hang Seng Tech into Chinex because this is also one of the sectors and one of the index that investors should look at, riding on the different teams for the 14 5-year plan and from the National People's Congress, healthcare and EV cars to ride under the theme of carbon neutrality. So there are some of the 3 names that are actually very are providing lithium batteries for EV cars. So these are some of the performers for related to EV cars. So they have huge potential going forward, riding onto the government initiative. The next slide, please. And this is actually a description of the Chinex ETF. I'll hand over to Ben.
Yes, the Chinex ETF, for the CSOP Chinex, has also tracks an index, tracks the Chinex index. 3147 is a ticker code. I think the Chinex is all about growth here, and it's actually quite difficult. I mean, for retail investors to find a lot of these stocks, as Adrian has mentioned earlier. So this ETF actually has encompassed a lot of what Adrian has said. Oh, the 1-year performance for this ETF is actually at 56.11%, and a lot of these companies within the Chinex has actually benefited from the COVID pandemic. One of it, I may add, is Mindray, which is actually they do a lot of ventilators throughout. Using that has benefited throughout the 2020.
All right. Yes. So back to the national Chinese government's initiative, right? So I did touch about China. I mean, how US actually banned chip export to China. In terms of protecting their IPs, right? And China actually import about 300 billion US dollars annually in terms of chip. Now with this ban going forward, China felt that we can turn ourselves from just manufacturer into a branding nation, which means that they want to produce their own chips, want to be self-reliant in terms of the production of chips. So going forward, we look at some of the 5-year plan that they have put up in place and how it benefited from that particular sector. So the 11th 5-year plan is about abolishing agricultural tax, right? They want to boost their own agriculture going forward. And you can see that the agriculture index, thematic index, outperformed the CSI 300 index. The 12th 5-year plan, they want to talk about being green, and they want to protect the environment. And you could see that the environment protection index outperformed the CSI 300. Next, the 13th 5-year plan, right? They want to talk about healthy China, and the healthcare index, right, outperformed the CSI 300. So any government-led initiative will definitely lead some kind of outperformance versus the traditional, the broad-based index within China. So we believe that the 14th 5-year plan, Star 50 index would definitely expected to outperform the CSI 300. Next slide, please. So we have a Star 50 index, and what they do is actually they focus on the hard tech, right? On the hardware of the technology innovation. And this Star 50 index is 70% into IT, 60% into semiconductors exposure. So it's actually focusing on the hard tech. So we have the Hang Seng Tech Index, we have the Chinex Index, and we have the Star 50 Index. So how do we position our portfolio for this? Is in the sense that riding on the initiative to be the Chinese government to be independent in terms of chip production on tech, high tech, hardware kind of tech innovation, expose yourself to Star 50 Index. If you want to go for the clean energy, renewable energy, EV cars, biotech, right on the potential increase in healthcare growth, go for the Chinex Index. Now the Hang Seng Tech Index is actually more exposure to the soft tech, right? It's more about the mobile apps, those kind of apps that is actually more for disruption of daily lives. So back to you, Ethan.
All right. Thank you, Adrian and Ben, for sharing. So I think right now they have shared so much. Okay, let's go back to the the previous slide. So right now they shared so much on all these the China and the Hong Kong sectors, right? So what interests me as a retail investor is that wow, I didn't even know that there are so many of these index that actually has differences, right? Because for retail investors that have little or no exposure to Hong Kong or China market, you only heard the big names like Alibaba, JD. That is, these are the big names, but there are actually so much more that this index actually offers, right? So let's move on to the Q&A. All right. So this is going to be interesting, right? So let's answer this question from Mr. Anonymous. All right. So he actually asked, of course, Alibaba was recently fined by the regulators, right? So I think this question is probably directed to Adrian. Are you aware of any more of this such regulatory action against Chinese tech companies? So will there actually be new rules or laws introduced by the government? What do you think, Adrian?
So I had the opportunity to speak to my portfolio manager, who is actually stationed in Hong Kong and close to what's happening there right now. True enough, we're actually facing a bit of regulatory scrutiny from the Chinese government, right? on one hand, they need these Chinese companies to help them to be self-reliant in terms of technology innovation, right? They to be honest, this Chinese government doesn't want to kill the company, right? They want them to, hey, play within a small little sandbox and be safe. Why they are doing so is because it's not what they are doing, it's actually how they're doing. And Chinese government, most importantly, wants to protect is the consumer data, the data that these technology companies have. So they don't want them to become too powerful. That would, and if they were to fail, it will provide some form of too big to fail kind of scenario that happens to the global financial markets, to the US banks as well. So would there be more action right now? Yes, there is actually just latest Chinese government has actually just informed 34 internet companies, hey, you guys got to you guys got to play within the criteria, and then play within the law and the rule. Any new rule will be imposed by the government. I think right now they has already set the tone and the rules already. So it's actually Alibaba is done and dusted. That's where we turn our views into Hang Seng Tech. I'm sorry, we look at the Tencent. We look at Tencent. So we believe that Tencent would be the next one that is actually going to be under scrutiny. But looking at the PE chart just now that I show, the valuation is already very fair. If there was any adverse news, we believe that's actually being baked into it. And just like what happened to Alibaba after the announcement of that they were being fined, the market, the ADRs, rallied by 10%. So we believe that's the scenario will happen to other technology companies as well. Go through a big painful caning from the Chinese government, and then be a better student going forward. Yeah.
Okay, thank you, Adrian, for answering that question. So, Mr. Anonymous, hope Adrian answered your questions, right? If not, you can always email him. Later, I'll show you guys his email. So I think the next question is, another Mr. Anonymous, right? So, how to actually invest in the Star 50 index. Adrian, you want to share, or Benjamin, you want to share about this? He's on mute.
Yes, he's on mute right now.
Yep.
Yes.
Yeah. Yes, that's actually a good point. The CSOP Star 50 index was actually incepted in a couple of months ago, on 10th of February. So, as Adrian has mentioned earlier, the Star 50, dominant sector is in the IT space, in IT technology, in the semiconductor space, and the ticker code is actually 3109. So it is new, with a 50 holdings for the Star 50 CSOP index. So I think that's where we can get started and how we can get invested into that.
Okay, thank you, Ben, for sharing. All right, so just to repeat, the ticker code is 3109. All right. So I think another question, I think probably for Ben as well. So Mr. Chong Hui is actually asking, isn't the 3033 tracking the HSI Tech Index passively? So why does it actually have such a high expense ratio among the 4 HS Tech ETFs listed on HK? Yeah. Do you have any insights on that?
Can I pass that question on to Adrian? I think Adrian's man.
Wow.
Why? I mean, as a ETF show, I mean, the fees. This is the fees that If you have, just any brief insight of why this is. Yeah.
Well, but we were the first to launch the ETF, and being the first, we have to secure. We have to pay a bit of a premium to secure the rights to the index, and to and we have to engage the many market makers to ensure there's robust liquidity and trading with trading system or like ecosystem within Hong Kong, right? And that's the reason why we have 12 market makers to ensure that the bid and ask spread is actually very tight for Hang Seng Tech. And also for us, we actually use full replication. That means we do not use any kind of form of derivatives in terms of to save costs and stuff like that. We are backed by the underlying assets of the underlying constituents as well. So back to why we engage a lot of market makers in a sense, because bid and ask spread is too wide. Investors could get in and a bid and wider bid and ask spread. It's actually an implicit cost that most of the investors do not understand. That if you in that scheme, you may save on the on the management fees or total expense ratio, but each time whenever you go in, you're actually paying a wider premium in terms of getting from the NAV, right? And that's actually hidden from you, and that's actually it would affect your entry price tracking the NAV. So that's the reason why we are actually back. So we use full replication. The cost of execution is a bit higher in the sense. But we will say that we are doing our best to provide a lot of information in terms of the market updates and everything, like here, and not only in Asia but also in Singapore as well. Yep.
All right, thanks Adrian for answering your question.
Yep.
I think Chi Hong, you can actually go back, rewatch the video. Is on one of the slides as well, whatever Adrian covered earlier. All right, let's move on to the next question. All right. So, this is probably for Adrian as well, right? So what do you think about, China's plan on rolling out digitalized renminbi? So are there any companies that actually would benefit from this going forward?
Well, I think most of the technology companies would definitely be beneficial for it. I think China is actually the first country to have a digital currency. And I mean, like, if the government says it's okay to, transact in digital yuan, that would actually open up much easier kind of transaction between merchants, between consumers, and and sellers and things like that. So I think the floodgates open. Technology companies, all the technology companies, in fact, would definitely benefit from this. A nod from a sign of approval from the Chinese government. Yes.
Okay, thank you, Adrian, for answering that question. So we have time for two more questions. All right. So I think this is open to Ben and Adrian as well. So Mr. Anonymous again, right? He's asking, with the US led political scene and into the the Taiwan and the China thing in the seas, what about the military actions, right, that could actually potentially affect China? Is there any do you guys have any insights or opinions on that in terms of military?
Again, this is actually well, we think that Taiwan is just a chip on the table between two rivaling superpower. Well, we do understand that China is actually growing in terms of size. We forecast. I mean, many people believe that China would be the top economy by 2030 and everything. But right now, we believe that China would actually tread really carefully in terms of managing the relationship with the neighboring countries as well. I think the One Belt One Road initiative is something that there's also one that how they build relationship with the neighboring countries within China. How it will pan out, it's anybody guess. Yeah, I wouldn't have any insight onto that. It's something that's actually beyond my scope. Yeah.
Okay. No worries, Adrian. I think this question, it was because all along it has been that way as well, right? Okay, let's one final question, right? So this final question is actually what is the outlook contrast between US tech and China tech? Do you guys have any opinions on that?
Well, I think for us, we have been monitoring the relationship between Nasdaq and the Chinese tech, right? Just before Chinese New Year, before February, and with a short history span, we see a very tight relationship between Nasdaq and the Hang Seng Tech itself. So the relationship is actually as tight as 0.88. But right now, recently, we observed that the relationship has actually has diverged, you know, and the relationship, the relationship is right now, I believe, on a weekly basis is actually about 0.5. So the relationship is, we could see a decoupling between these two indices going forward. Yes.
And I can add to that too that the China the tech index actually when it both rallies, it rallies stronger than the Nasdaq itself. But as of now, even as of last year when the pandemic happened and we had a huge drop, it actually rallied more than the Nasdaq itself, reaching to really to highs of, as I mentioned, 11,000 last year. So, and I mean, sorry, early this year into February. So I think overall, all in all, it's a good strong correlation between the two, except for the recent divergence, as Adrian has mentioned.
All right. Thank you, Adrian and Benjamin. Okay, guys, we've come to the end of the webinar, but don't go yet, right? So, you know, for this webinar, we're actually exclusively partnering with CGS-CIMB, right? So we actually have this ongoing promotion, which you buy 5,000 units of ETFs and you get 5 units free, right? So this promotion is actually valid from 1st April to 30th June this year. All right. For more information, please scan the QR code. Let me give you guys the link as well. I'll put it into the chat so that you guys can actually click and see it. All right. Just give me a minute. All right. Right. Do check it out. Okay. So last but not least, right? If you have any questions that were unanswered by Adrian, please do email him at adrian.chew@csopasset.com. Right. Once again, Adrian is the vice president of vice president of sales and product strategy at CSOP Asset Management. Right. So for account related inquiries, please email to nixon.neo@cgs-cimb.com. Guys, this is the end of the webinar. Thank you so much, Adrian and Benjamin, for being our special guests and giving an insightful webinar that our audiences enjoy. Right. So we'll keep in touch for the next webinar. It's going to happen in a couple of weeks. Right. So thank you once again, Adrian, Benjamin, and everybody who is attending this webinar on this beautiful Wednesday evening. Right. Catch you guys. Thank you.
Thank you, Ethan. Thank you, Benjamin.
All right. Thank you, guys.
Thank you, everyone.
All right.
Thank you.
Thank you.
Bye.
Bye.